Well, hello, everyone, and welcome to a special event here on StockCharts TV. Of course, our flagship panel for charting the second half here in 2021. Thank you so much for joining us here on StockCharts TV. My name is Grayson Roze, Vice President of Operations here at StockCharts.com. Thrilled to be with you today, and even more importantly, thrilled to have my three guests with me today. Some incredible charting firepower from our group that we have today. Going to bring them on in just a second. Let them say hi. Before we do that, though, I want to give you a sense of how this panel is going to work, sort of what our mission is, and how we're going to run things today. So what we've done with our three panelists, we've asked each of them to bring two charts to the panel. First chart, kind of looking backwards before we look forwards, we've asked them to bring a chart that represents the first half of 2021, something that stuck out to them, whether it's an important technical theme, a key move, a key development, something that's really caught their eye that represents what's happened, sort of what the story is for the first half of 2021. After that, we've asked them to bring a second chart to the panel that's what they're keeping a close eye on in the second half of the year. So again, as we're charting the second half, as we're looking forward to the future, something that they are keeping a close eye on in this market. So a lot to cover here with these different charts that our experts have brought on. Of course, after that, we're going to ask them some questions. We're going to kick it off with a good discussion, let the group kind of talk to each other and just see where the conversation goes. Again, some incredible experts we have today. So I'm really looking forward to seeing what they've brought, and then, of course, where things go after that as we dig into their charts and what they're seeing in the markets. Now, with me today, I want to bring on our guests, introduce everyone one at a time. First off, we have JC Parets, founder and chief strategist at All Star Charts. JC, thank you so much for being here. Good to see you.
You got it, Grayson. Anything you need. I've been using StockCharts so long, I don't remember not using StockCharts. How about that?
Yeah, we've been tracking you. I mean, we're like, what is this guy doing? Why is he always on StockCharts? This is crazy. He's got to get a life. It looks like you got a life there, though. You got the sunshine behind you and everything. It's beautiful.
Salute,
next up, we have John Kosar. John is the chief market strategist at Asbury Research, a frequent contributor here on StockCharts TV. Also, John, you were with us on last year's panel, so it's good to have you back. It was such a screaming success that we said we got to get John back on this year. How you doing, John?
I'm doing great. It's nice to be back. Thanks for the invite.
Yeah, looking forward to what you brought with us. And of course, finally, we have our good friend Jay Woods. Jay is the chief market strategist at DriveWealth. My memory of the last time that I got to see Jay in person was what ended up being one of the final weeks on the floor of the NYSE. Crazy to think back to that, but Jay, so good to have you on here. Thanks for coming on the show. How you doing?
I'm doing great, and I'm excited to be here with this panel, to see you and talk to the StockCharts team. I know we have a lot of good charts to look over, so I can't wait to get started.
Yeah, we're gonna have some fun today. So I think we're gonna kick it off, JC, with you. I know you brought some great charts. I'm gonna take the screen over and put your charts up on the screen, but give you a couple of minutes to just kind of run through. Starting with that chart that you brought for sort of the first half of the year, and we'll dive into the second one after that. But what are you seeing? What did you bring with us today? You got a pretty interesting chart up on the screen here. What is it? Talk to us.
No, I appreciate that. So this chart goes back 4 or 5 years, but let's focus specifically on what's taken place so far in 2021. And the headline is going to be S&P 500 hits new highs or NASDAQ hits new highs. But at the end of the day, it's a market of stocks. And that gets forgotten, right? It's always, what's the S&P do? What did the Dow do today, JC? But at the end of the day, there's so many components to this market, depending on who you ask, 6,000 stocks, there are 3,000 stocks in the Russell 3000 alone. So we want to look underneath the surface to see what's actually happening. And this chart really shows an interesting correlation over time. Broker dealers or the broker dealers index is on my Mount Rushmore of the most important sector indexes in the world, in my opinion, whether you live in the United States or not. The broker dealers index, you could follow it by using the ticker symbol IAI. So on a relative basis, it looks a lot like emerging markets over the years. And, EEM, and then you can really see how emerging markets have really gone sideways to down for most of the year. Same thing with broker dealers underperforming. And then down below, we have a custom risk on, risk off ratio. On the risk on side, you have things like copper, high beta stocks, semiconductors, Australian dollar. And then on the risk off side, you've got things like Japanese yen, US Treasury bonds, gold, utility staples. So really gives us a gauge of whether there's risk appetite out there or whether there's more risk aversion. And I think for the majority of the year, it's been a chop fest. And when you zoom out and you look at other year twos of cycles, look at 2010 after the initial thrust of '09, it looks a lot like this. Look at 2004 after that initial thrust of '03, looks a lot like this. Look at 1984. Look at 1983, 84. Look at 1976 after that initial thrust in 74 and 75. So this messy market is really just a classic characteristic of year two of cycles. In fact, if the market wasn't this messy, that would be unusual. So this is really perfectly normal and consistent with all historical examples in the past.
I love that. I love that you're talking, sort of historically about year two of cycles, thinking about, what we've seen in the past and how that's driving what we're seeing now. I mean, that's such a great point too, that, people get so caught up in the day to day and what's happening and everything. But if you think historically about, is this normal? I love that you're answering those questions. You've got a second chart with you that I want to flip over to now, which is a pretty interesting one. What are you seeing on this small caps and micro caps chart, sort of two together here?
Yeah, so Grayson, you gave me a homework assignment. You said the first chart, what tells the story of the first half the best? I think it's that lack of movement and choppiness. And then what are you looking for moving forward? I can give you 1,000 charts, but my homework assignment was one. So what we're looking at here is we're looking at small caps and micro caps really churning sideways since February, like chop, 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 chop. Right, classic year two behavior. But here's the thing, everybody's talking about how bad breadth is and how bad market breadth is. And it's not so much that market breadth is bad, it's just not good, and it's not getting any better. But it's not getting worse either. So while we're not getting an expansion in new highs, we're also not getting an expansion in new lows. So it's not so much that breadth is bad, it's just not good. Right? But it's not getting worse either. So at some point, something's got to give. Either these ranges are just, springboards to a new leg higher, or they're tops. We don't know. My suspicion is we ultimately break out higher. The question is, how long is it going to take? And I think that the new lows and new highs list is probably going to be a good indicator. So if we get an expansion in new lows, chances are the indexes will follow. And if we start to see an expansion in new highs, chances are the indexes will follow. As the great Wu-Tang Clan once said, is that cash rules everything around me. Dollar bills, y'all. There's nothing wrong with heavy cash positions. That's been smart this year.
There you go. JC, when I look at this chart that you brought with us of small caps and micro caps, a couple of things come to mind. But first and foremost, especially when you're talking about the chop that we're seeing, people love to think about the uptrend. They love to think about the downtrend. They love to think about things going up, things going down. People love to forget about things going sideways. People love to forget that that's the third thing that stocks or indexes can do. Assets can trade sideways, and that in and of itself is something. And that sticks out to me so clearly, especially with the highlights that you've done here on small caps and micro caps. Talking about the chop, talking about the sideways.
I appreciate that because people are like, well, is it going up or is it going down? It's like, well, sometimes it's not doing either. And this is a great example of that. And by the way, I have like crazy post-traumatic stress disorder of getting chopped up in markets like this. So like, I recognize this and I'm just like, this is not for me. I've been there, I've been there, done that. It's no fun. And I know a lot of traders all over the world that are getting chopped up because they don't have that post-traumatic stress disorder that I have. So, my emotions kind of, my brain is like, it recognizes this hot mess, which we recognized in March, thank God. We've been in heavy cash positions ever since, tight stops, that's really been the strategy. And that continues to be the strategy until we suggest otherwise.
Yeah. Well, there's an interesting connection here. I'm going to just put my cursor over it so people can see. I'm not going to say it outright. I want people to catch it. There's an interesting connection here, though, between you and John. So we're going to move on to John. John, I'm going to bring you on. You've got a couple of great charts that you brought with you as well. So we'll flip over to that now. Actually, first up was the S&P 500, right? You were taking a look at the S&P 500. So for that first chart, kind of looking back at how you're thinking about the first half of the year. What are you seeing on this chart of the S&P 500? A lot of annotations here. I want to walk through all this with you.
This is kind of the poster boy of how I saw the first half. It was I've never seen the buy the dip urge just as consistent and strong as I've seen it. It's Pavlovian kind of thing. You ring the bell, you buy the S&P when it comes down to the what we would call the tactical support area. You could see it as the 50-day moving average here in blue. So since Jan 29, 1, 2, 3, 4, 5, 6, you could argue there were 7 or 8 in there. And the interesting thing is that this happened, a lot of this happened, the buy the dip urge happened while all the leaders were underperforming. Since the middle of February, you had underperformance from both the NASDAQs, from small cap, from semis. We had some help from energy and financials since the end of last year. I think that kind of helped to shore this up. But a lot of this buying of the S&P 500, I think, was FOMO. Is fear of missing out. We're coming out of COVID now. There's a lot of pent up demand to travel, to go out to dinner, to do things. They have a life again. So the outward thing is the buy the dip is really strong. Nobody wants to miss the next big move up. But the behind the surface thing is leadership is real skinny. And if it doesn't start to pick up, I think we're going to have problems in the second half.
Yeah, it's been interesting to watch that leadership shift this year. I mean, especially from 2020 to 2021. I've been watching this too, the resiliency of that 50-day. I mean, every time we get down to it, I mean, look at this, like you're highlighting 6 times, every time we get even remotely close, buyers step in and we've got a market that's bouncing off that 50-day. It's wild. I'm curious to ask you your thoughts on this. If we do see another test of that 50-day and we actually fail to hold that 50-day, do you think it's going to be sort of, more severe? The reaction to that is going to be more meaningfully severe to the downside because we've lost such a resilient support level? What do you think about that?
It's always hard to forecast, because it hasn't happened yet. But
Right.
my sense is one of these times there's going to be people stepping in. You could see around 42.32 is where it is now. And everybody's been stepping in, and it's been a big party. If you look at the total net assets going into the spiders and going into the QQQ, those assets turn on a dime and just money just comes pumping in there real hard.
Yeah.
My thought is one of these days it's not going to hold. And you're going to catch a lot of people off sides really fast. And that can kind of light the candle for a move that I think could take us back down to the 200-day moving average, which is, let's just call it 38.80. And then there's more support down there around 38.50. The other part of that is if you look at the percentage that the S&P 500 is up above the 200-day moving average, 14-ish. The put call ratio is extremely low. Sentiment, extremely low. All the traditional stuff that told you the market was out over its skis has been stuck there for 3 to 6 months. So yeah, I do. I think when that thing breaks, the initial candle is going to be people getting shocked that the 50 didn't hold. And then ultimately, the market eventually goes back to the mean, and your mean is 38.80.
Sure. No, I mean, markets send us signals, right? That's what we get to see on the charts. And there's a clear signal about the 50-day right now. So I think it's interesting to think about what the signal would be if we lose that 50-day. John, I want to move on to your second chart because it's a great one, something that the group was talking a lot about actually before the show. It's fun to talk about this. You brought semiconductors, SMH. What are you seeing on this chart?
Well, I talked about the lack of leadership. So what took us from the low that we made on June the 18th, that was the last time we tested the 50, is you got some outperformance out of Apple, out of both of the NASDAQ indexes. And that outperformance really kind of took us to where we are now. I've been watching the relative performance like a hawk. It's starting to peel off a little bit in both of the NASDAQs, and you're still underperforming in small caps. So I'm looking at semis. Semis often lead tech. So we had a nice breakout of 3 months, 4 months of sideways investor indecision on June the 28th. A simple chart pattern, triangle. The market went from period of indecision back to resuming the bigger trend. but it's struggling. In fact, that chart's a day old. We actually fell through the top of that pattern, which is 254.70. So I'm thinking if tech is starting to run out of gas over the near term and we're going to lose semis, and if you scroll to the bottom, that bottom chart is the relative performance of SMH versus SPY. That green line is the 63-day moving average. That's the quarterly relative performance trend of SMH versus SPY. You can see it's gotten up above the 63 there, but it's sputtering too. So to me, this chart is pretty integral in terms of what happens between now and Labor Day. If we lose tech, which they've been floundering a little bit, we get a failed pattern here, we get underperformance coming from semis, and we don't get anything out of the other typical leaders, your small cap. We could start a correction here before Labor Day. So I really think this is a big deal on this particular chart.
Yeah, that's interesting to watch. I mean, obviously, the semis is such a great bellwether, not just for tech, but for really kind of the markets as a whole. Something I watch closely, something I know Dave Keller watches closely. A lot of us watch that group like a hawk. So it's interesting to see. I love that you've got this relative strength line too of semis versus the S&P 500. By the way, for those of you who didn't catch it, here's that connection between JC and John. We've got the 63 period moving average. Again, like John mentioned, quarterly moving average, the number of trading days in a quarter there. So love to see that connection between the charts that you guys brought. That's always fun. Jay, we are going to move on to you. You brought some incredibly fun stuff with you. I know you've got a lot to cover. Should we pull up that subway chart at the beginning here?
Yeah, one of the questions I get being in the New York area, working at the stock exchange and now in Jersey City, back and forth, is New York reopened? Is it coming to life? And this is kind of representative. This is a 5-year chart of the MTA, which is our subway system here in New York, the turnstile entries into Manhattan. And it's one of the ugliest charts you'll ever see. But for 4 years pre-COVID, we bottomed at 1 million riders, and that would be on a weekend, a holiday, and we peaked at 3 to 3.5 million riders per day. Then COVID hit, you can see the crash, and the slow comeback. The second wave of COVID hit, we went back down, and now we're kind of plateauing at the million where, old support becomes resistance. And I'm predicting in September, once, we get through Labor Day, kids are back in school, everyone's back in the office, we're going to have a major breakout in that number. But if you want a chart of the reopening in New York City, there's nothing better than this one.
Right. I mean, talking about a theme that sticks out, something that captures the first half of the year and last year too. This is a fascinating chart. I mean, for us as data visualists, right, this is pretty cool. It's about as good as it gets. I want to flip over though to some of your other charts that you brought with you. Yeah. Should we start with Apple?
Yeah, let's go there. You talk about themes and capturing meaningful moves, and you try to come up with something clever and not predictable. And then I give you Apple, and I apologize. It was between Apple and Amazon. Basically, the theme was we saw rotation from last year's laggards, energy, financials lead, and then the stocks that took us out of the COVID, led us up until early September of last year, just paused. They made a monster move and they digested those gains. And now all of a sudden, the new leadership as we kick off the second half of the year is Apple, is Amazon, Google, Microsoft also making new highs, Facebook. These are the leaders you want to see. Just based from a market cap perspective, this leads me to say, okay, we can't make any bearish calls. And if we're going to be bearish, it's going to be a short-term pullback. What will that pullback be? Okay, we retrace to the old resistance, new support in a worst case scenario. So to see the leadership in the large cap, and if you go to Amazon, I think we're going to show Amazon in the next CMTA booklet for your basic breakout and uptrend resumption on a longer term basis. This is as textbook as it gets, and this is the leadership we want. There were a lot of news stories about Bezos leaving, and will they ever recover? Well, we took off like Bezos in a rocket ship as we broke above that new high. And
Right.
to me, there will be some weakness and rotation, but with the rotation back into the big name tech and discretionary in this case, it's hard to be bearish long term.
Yeah, it's certainly the case. I mean, it's tough to think about a market that's going to move meaningfully higher without the participation of Apple and Amazon. I mean, just such huge names in the space. And to think when we've also got, I think we had a chart of Google in here too. We've got Google, we've got Facebook, some of these other mega cap names, moving higher, leading higher. To see Apple joining that party, I mean, it makes a ton of sense.
And then when you dig even deeper, you look at the individual sectors that they represent, and they're 20 to 25% of those sectors, whether it's technology, communications in Google, or tech with Apple. It's just it's hard to see a major pullback when these guys, the generals, essentially, are leading us higher.
The generals, I like that. Jay, you brought another chart with you too, which was Hack. Talk to us about this. This is one I've been watching for a while. A really interesting chart here. What are you seeing?
It's interesting on a couple levels, because one of the themes we talk about, we can talk about China coming to the forefront, and that would be very interesting with the semiconductors, seeing Taiwan Semi being the largest component there. But for me, one of the things that we worry about from the New York Stock Exchange point of view, from the technology side to the DriveWealth side, is cybersecurity. And the theme that continues to come into play is, are we prepared for the next big cyber attack? People are holding companies hostage for Bitcoin. So let's look at what would move if there was another cyber breach, and it would be the stocks in this index. If you were to do a deeper dive into what moves Hack, there isn't one main driver, and I found this very interesting. It's 3%, no before. Cisco is the biggest name in it. Cloudflare, Darkspace, Splunk. Splunk is a stock that's been beaten up, but it just broke an intermediate term downtrend. It still has some work to do to get back to its 200-day moving average. But these stocks are starting to bottom as well and turn, and I see that we're making higher lows every single time. We test this pattern. I could see a breakout and possibly a 10 to 20% move to the upside from here.
Sure. I'm curious to know, have you looked at some of the other cybersecurity funds that are out there? I mean, there's been a lot of talk about cyber as the other one, CIBR.
Why don't we?
Composition
let's put it up there.
Yeah, let's pull up a chart of cyber. Oh, here we go. Let's go back here. Are you watching some of those other? This one's kind of broken out a little bit more.
I mean, this should follow. This is what I'm thinking Hack is eventually going to do, follow in the footsteps of cyber. We had that breakout. We've maintained it, and now we're flagging a little bit. So to me, this is the space that's going to be the next hot thing. That was another theme we saw in the first half of the year, whether it was EV, solar, SPACs. There was a rotation, and when the rotation happened, it happened quick. It was 2 to 4 weeks, and these things took off like rocket ships. And I see one more breach. Cyber's already telling us that we're breaking out, and Hack is soon to follow.
Yeah, no, it's interesting. I mean, we've seen some of those other 2020 themes really start to take off too. We've seen stuff like obviously semis, gaining a little bit of strength, but even software, online retail, even corners like pet care, which were big winners in 2020, start to sort of resume that move to the upside. Interesting to see. Guys, we've covered so many great charts here. One thing that I'm interested to just kind of open up to the group. All of you have mentioned semiconductors. Talk to us about sort of how you see that space. I mean, we've talked about it a little bit as kind of a bellwether for the market as a whole, maybe. But talk to us about kind of the importance of semiconductors and why you're each keeping an eye on it. JC, maybe we can start with you, because it's been a while since we've heard you at the start of the show.
Yeah, no doubt about it. Listen, for me, I look at semis in a couple of different ways. We don't have bull markets in technology without the participation of semiconductors, right? For me, it's like a leading indicator.
Right.
And then you could take it one step further and look at it almost like a commodity. Semiconductors are like the commodities of technology. So they're really important. I'd venture to say John and Jay have brought it up because they're the only things leading. I think John alluded to that. There's just a lack of leadership out there, and
Yeah.
we're just not getting an expansion in new highs. And when you see deteriorating new highs and deteriorating participation, and then you bring in sentiment into the conversation, and there just aren't any bears, the market has a funny way of creating new ones.
Yeah. I'm curious, guys. Also, to kind of step back. We'll step back from the individual groups and things. Let's talk about something that you were touching on, JC. Kind of going down the cap tiers a little bit. This weakness in small caps and micro caps. One that we actually didn't talk about was the weakness in mid caps too. Mid caps really starting to roll over and kind of testing their 50-day from the bottom. Do you guys think that this is gonna really start to infect other corners of the market, or do you think that the mega caps, the big caps, are gonna sort of start to pull those groups higher? What do we think? Maybe John, we could start with you. We'll pull up some charts here as you're starting to talk.
Sure. I look at the fact that we're not getting any kind of leadership from the mid and the small cap, in a sense, is kind of a lack of risk appetite. And you see that obviously Apple's doing really well, and so is Amazon. Those are two that I've been watching, right along with Jay. They're actually starting to outperform the S&P 500 in a big way, and that's really helped to keep the market afloat as a whole. But my sense would be, I don't like to see large cap, leading. I would rather see a little more risk appetite and see, some money going into small caps, or JC kind of looks at the semis the same as I call them the tip of the spear. Mm-hmm. That's typically, if you've got a good, strong market, you're going to get some kind of leadership out of semis. You're going to get outperformance. That's where the money goes when people want to try to play for outperformance. Typically, where the money goes when people just want to hang in there and just try to relative perform, they go to the S&P 500. So right. All that to me sets up a little. It looks more negative than positive heading into that. We don't have any leadership anywhere except for large cap. I don't think that's good.
Yeah. Jay, what do you think? I mean, does this sort of weakness in some of the smaller cap tiers, that give you pause on this market?
Well, it's more of a rotation to me, and of course it gives you pause. If you go back to JC's chart, if you punch up the SML, which is the small cap 600, or the mid cap 400 MID, you're going to see those. We're starting to look like we're rolling over, but the weight of the evidence is still uptrend, still neutral. Digesting those gains, does it give you pause? Most definitely. But to me, it's another part of this rotational market that we continue to see where, all right, we're in the large cap. Where do we get that money from? Let's take from some of our winners before. Look at the Russell, RTY. That's at a critical level to me. That thing has been, ascending, triangling, if that's not even a term, but it's been in a nice ascending pattern for a while. And we see it at the bottom end of the range. And we know there are technical algos out there that are looking at this level carefully and are going to nibble. And these are the levels that grab my attention because you get that rally and you're going to see a big bounce. And then getting back to the 200-day moving average in the S&P, this is something I watch very closely. We are a little overextended there. We haven't had a 5% correction since September. To see the bigger indexes correct 3 to 5%, someone like Tony Dwyer goes on CNBC and they're ready to hang them. These are normal everyday moves. To see a 5 to 10% correction is also a normal everyday move. And maybe we're in the process of that. We have seasonality factors in play. August and September are the two worst months historically going back to 2000. September, the worst month of all time. So there are headwinds coming, and this is just kind of the first breeze, if you will, through the channels. But is it something to, run away and raise, 100% cash? No, not at all.
Yeah. No, it's a funny perspective to have. I mean, I think as technicians, we're so objective about this, but other people in sort of other corners of the market get scared by it. This concept of healthy markets moving in a series of rallies and reactions, and healthy markets move up and down. And when you see a market, I mean, like we've had here, that's been so flat to the upside, just sort of foot flat on the gas, moving to the upside, so resilient. it's kind of starting to not feel healthy when it's moving like this. But JC, I want to go back to the breadth conversation because I think it's a really important one. We'll actually pop over here and pull up a key breadth chart. I want to get more thoughts from you on that because I think the points that you were making were really key there. How are you thinking about breadth? Here, what we're looking at is percentage of stocks in the NYSE above their 200-day and their 50-day, and then below that we've got the S&P 500, same group, and the Nasdaq. How are you thinking about some of these metrics? I know they're things that you watch.
Yeah, of course. And when you talk about the market just grinding higher, like I'd push back on that. It just simply hasn't been that. You can isolate a couple of indexes and sure. You can suggest that they have, but we have had a severe stealth correction underneath the surface. Depending on what universe of stocks you're describing, the average stock drawdown is down 10, 12% off the highs. So we have seen corrections both through price and through time, depending on which sector, which indexes you're looking at. So, this grind higher, that's just not the case in the real world, in the real markets. Maybe in a few cap-weighted indexes, sure. But when you look at equally weighted indexes, when you look at the value line indexes, when you look at the mid caps and small caps and micro caps, where us mere mortals have to live, we're not just buying the S&P 500 and hoping for the best. That's just not the way the real world works. And there has been a severe correction underneath the surface in most areas. So the question becomes, is the stealth correction the correction, and then we ultimately resolve higher this fall? Or is the stealth correction a heads up that the major indexes are now going to catch down to what the rest of the markets are doing, right? That's the question.
Yeah. Guys, I mean, Jay and John, how do you see breadth? Are these things that you watch closely? Are they on your radar? What are you seeing there?
I'm looking at I look at the NYSE percentage of stocks trading above the 40 for kind of a short-term tactical, and then I look at the 200 for more of a strategic, sort of quarterly. And the second one down on the screen right now, that's pretty close to the 40. That's the 50. But you can see that it's kind of a slow bleed down in the last third of the chart, second chart down. You can see there's kind of an erosion there. It isn't sharp, but there's an erosion. And then if you look at the percentage of NYSE stocks trading above their 200, from memory, it got up around 80% right at the end of last year. And it's starting to dive down. So there's a lot of stuff going on under the surface. Like JC said, if you just look at the S&P, you think it's happy time. But if you look at, is there leadership? What's the breadth look like? Where's sentiment? What are put call ratios doing? The S&P 500 chart by itself is very deceiving.
And to add on to that, we made 34 new highs in the S&P 500 in the first half of the year. But the last 10 over the last 3 weeks, if you were to look underneath the surface, and this stat was going pretty wild on social media, under 50% of the S&P 500 was above the 50-day moving average. We're seeing a lot of, the right leaders are taking us there, but the participation has not been robust. And, I think it was Ryan Dietrich did some digging, and we haven't seen a move like that since 1999. It doesn't mean we're going to go down, but in fact, we continued another 3 months higher after we made new highs with 50% of the S&P 500 under that 50-day. But it does give you pause that we just need to, watch. There are a lot of red flags, but this is nothing that's abnormal. JC just nailed it. 10 to 12% of every stock had a minor correction, a 10 to 12% correction. So once we get through this next quarter, I think we finish the year strong.
Yeah. And by the way, it's not anything new. Remember, this whole correction started in February. The advanced decline line in the Nasdaq peaked in early February. The list of stocks making new highs in the Nasdaq peaked in February. So this is not anything new. In fact, it was in March that we started really raising cash. And every time I talk about how great of a position cash is and cash has been, you know, the trolls come out in droves pointing to the S&P and the NASDAQ. And I'm like, dude, like, you don't live in the real world. So, like, you know, don't come at me. So number one, the trolls are pointing to a couple of indexes, arbitrarily so. And when you look at sentiment, I hate to keep dwelling on sentiment, but when you look at sentiment data, particularly, you know, the II and the AAII, there just aren't any bears. There just aren't any bears. So when you see new highs in the indexes, you're seeing almost no new highs in the stocks themselves, and you're not seeing any bears. There's a storm brewing, and I still like cash.
You know, something, you know, that Jay said, he was looking at some of the large cap tech. He looked at Apple, and then there was Amazon. I just kind of smiled here because I've been showing those charts to my clients for the past month, because right now, you know, they've held support levels, they've had breakouts, and they're outperforming the S&P 500. Those two all by themselves, there's so much market cap there. Those two can do a whole lot of damage, and damage is the wrong word, but they can really elevate the market. You know, you get a half a dozen stocks like that, or 3 or 4 stocks like that, and they can move everything higher. You know, the index is higher overall. True. And that's deceiving too. So you kind of have to watch where the little you know, the weak links are, or the potential weak links are. And in a narrow market like this, if you lose semis, you lose Apple, and you lose Amazon, this thing's in trouble.
Yeah, that's true. JC, I want to come back to you really quick, and then open this up to everyone else as well. You know, you're talking about a market of stocks. Let's dig into a couple of the sectors. We've seen some interesting movements here. You know, obviously financials were incredibly strong. Industrials and energy materials were incredibly strong at the start of the year. Technology was a little bit weaker, right? We saw that rotation over to value. We saw growth get really hit, but now we've seen that start to reverse. So how are you thinking about this? I mean, one thing that always comes to mind when I think about you, JC, is how you talk about the importance of financials for a truly healthy bull market. So how are you thinking about this weakness in financials? And Jay and John, from a sector rotation perspective, what are you guys seeing under the surface? Let's kind of dig into a couple of these sectors up on the screen.
Yeah, listen, we're short financials. I love a short financials trade. Continue to. I think it's an interest rate bond story is really what it is. If the U.S. 10-year yield is below 1.4%, you could be all in short financials, particularly regional banks. I think there's a small cap story there because you have a lot more bank exposure in the small cap space. So I think the whole interest rate, 1.4 is that big level. Those were the lows in 2012. Those were the lows in 2016. There were the lows in 2019, and then we broke last year. And then we tried to get back above it this year and failed. So if we're below 1.4% in the U.S. 10-year yield, I think you can continue to be very aggressively short financials.
Interesting. Jay, I mean, are you thinking this rotation over to financials is done and we're moving away from them?
Well, this was the show me week for the financials. If you put up that XLF chart, you know, we didn't test those highs. In fact, we failed it. What is that? What moving average do you have right there?
The 50. We got the 50 in red, that solid thick line, testing it from the bottom again.
Yeah, I mean, just look at the individual banking stocks that blew out earnings. They ran up into earnings, and they couldn't follow through. So price is dictating we're going lower here. They didn't want to make a run at new highs. The good news is out. So right now, and I'm looking at that 1.45 level in the 10-year as well. It's clear as day. As long as we don't trade above that, I can't see any reason for the financials to make that push to new highs, not at this point in time. But you did talk about rotation, and before I came on, you have some great relative rotation graphs on your indexes. If you could punch that up, I don't know how you're probably the fastest person to do that. The staples look very interesting right now. Look at Coke and Pepsi. Coke is about to make a 52-week high. It still has $5 to go for an all-time high. Pepsi broke out, strong earnings and a breakout. I like the positive news and the price reaction to it. Real estate just doesn't give any back. And now utilities, you know, boring, but, you know, the people are going to look for yield, and you may see utilities come back into play. So I look at this RRG chart, and you see communications holding on tight. Thank you, Google. Real estate, it just is a champ. But what are the next players to go into that space? And to me, staples are screaming right here.
Yeah. Guys, we're talking a lot about the the market of stocks. We're kind of digging in a little bit deeper. But in our last couple of minutes here, I'm curious to ask you all. The S&P 500, obviously the big daddy of the group that everyone's paying attention to. Right now, about 3% up from where we're sitting is 4,500. So I'm curious to know, because that would also represent a 20% gain for the year, 4,500 on the S&P. Do you guys think that we're going to make our way back up to that level or up to that level? By the end of the year, what are you thinking? Have we put in the top for the year, or do you think we're going to clear 4,500? Maybe John, we could start with you.
Sure. The one thing I've learned is trying to pick a top within a stock market that goes up 80% of the time is not good. So
I love that you're saying that.
You want to be long as much as you can because history is behind you. I don't like the leadership, as you know. There's a lot of stuff that is wrong with the market right now. We have a couple of tactical models that we use. It's the CPM and the Asbury 6. Those basically tell me what the internal health of the market is every day. And it's looking at corporate bond spreads and a couple of breadth metrics and some volume. And just it kind of takes the market's temperature every day. Those are positive. And I show tactical support in the S&P 500 right now at 42.73 to 42.35. That's 2 to 3% underneath the market. I don't care what happens, as long as those two models don't turn negative and we stay up above the tactical support. Even if I hate the market or I hate what might happen, or what if Apple fails, or what if the Sox fails, as long as that stays, to me, I think to most people, the S&P 500 is the market. So as long as that keeps going, I'm just going to ride this, until the music stops. So I would certainly bet on us going higher, rather than lower overall between now and the end of the year.
Jay, what are you thinking?
Yeah, I'm kind of in that camp as well. I think we're going to see a lot more volatility in the second half, which for a trader, that's fantastic. I mentioned the seasonal headwind, but the rotational trade is going to continue. We have an accommodative Fed, so I don't see, just listening to Powell, and I know we're technical only, but they're not going to do anything crazy to move this market. I know CNBC is going to be upset because there will be no markets in turmoil special, but a sideways chop and rotation under the surface is here for the next few months. Yeah. And then a year-end rally, we could see 20% gain for the year in the S&P. We had 14.5 for the first half of the year, so it's a modest gain from here, but the trend continues to slowly go higher.
Yeah. JC, we'll wrap up with you. What do you think? We making our way back up there?
Listen, I learned from a wise Egyptian man that if you trade the averages, you're going to get average returns. So for me, the S&P 500 isn't, I hate to say it's an arbitrary index. I don't want to go that far, but the truth is, I think it gets a lot more. It gets a lot more interest than it probably deserves. I'd say look underneath the surface, and the bond market's telling you there's a problem. The bond market's been telling you there's a problem. So do you want to trust the journalist? Do you want to trust the economist, or do you want to trust the bond market? I'll go with the bond market. Being long bonds is working. 3 consecutive positive months for bonds. And I think if the U.S. 10-year yield is below 1.4%, you stay long bonds, you stay short financials, and then, ask questions later and let the market prove to you that it's time to reverse that trade. And that's not now.
There you go. I like that you're calling that out, JC. I mean, you're keeping it real there. I like that. Guys, we got to wrap. This has been so much fun, though. I want to thank you all for coming on our Charting the Second Half panel here to wrap up the week. This has been a great week of content, but wrapping up with a panel like this, having you three on, sharing your charts, sharing your insights, so many incredible perspectives from you three. I want to thank you all. Again, for our viewers, this has been JC Parets of StockCharts, John Kosar of Asbury Research, and Jay Woods of DriveWealth. Guys, thank you again so much for coming on. Viewers, of course, you can find all of this content for the whole week that we've been doing here for Charting the Second Half up on our YouTube channel, as well as our on-demand platform at StockChartsTV.com. So lots of different ways to watch. Make sure you're catching up on all the content. But hopefully you've enjoyed the incredible insights here from our panelists, John, JC, and Jay. I was saying before the show, I feel left out because I'm the only guy here whose name doesn't start with a J. So I think I'm going to sign off as Jason instead of Grayson. I'm just going to go ahead and throw a J on my name and call it a day. But I want to thank you all for watching here on StockCharts TV. We will see you again for another special very soon. And until then, chart on, my friends.
Hey guys, Dave Keller here with StockCharts.com. Thanks so much for watching our video. If you enjoyed it, and we hope you did, hit the like button right below. Also, we have so much new content every day. Consider subscribing to the channel. Just hit the subscribe button in the video or right below. Thanks for watching. Stay safe. Have a fantastic day.